Welcome to this edition of Diligence Inside America's Boardrooms. I'm TK Kerstetter, and I'll be your host for today's show. Today, we're going to talk about insider trading and what you should know as a board member. And joining me to discuss this is Greg Watts, who's a partner in litigation for Wilson Sonsini, Goodrich, and Rosati, and Jose Macias, who is also a partner in the corporate practice of Wilson Sonsini. So welcome, guys.
Good to be here.
Insider trading, while probably not always publicized, I'm of the feeling that it's still pretty prevalent in the U.S. Among public companies and U.S. boards. We just only hear about those big sort of famous cases, but I think that it's still relevant, and particularly with the administration change in the White House and in Congress, and a new SEC chairman. So, Greg, I'm going to start with you since you're the legal aspect of this. And could you just talk about the current status of insider trading and sort of what you're seeing with any of the administration changes?
Yeah, sure. Happy to, TK. Thank you. So to remind your viewers, illegal insider trading refers generally to buying or selling a security in breach of a fiduciary duty or another relationship of trust or confidence on the basis of material non-public about that security. So insider trading involves, as we all know, it can include tipping such information, securities trading by people who may be tipped or receive the information, and securities trading by those who misappropriate that information. Common examples of insider trading are corporate officers and directors in the corporations who trade in the corporation securities in advance of public disclosure of significant corporate developments, or friends, family members, associates, or other tippees of such officers and directors who traded the securities after receiving such information. The third category would be employees of professional service providers like law firms, investment banks, accounting firms, who trade based upon information they learn while servicing that corporation. The SEC's civil remedies against individuals include disgorgement of the insider trading profits plus interest, penalties of up to $1 million, and a possible lifetime bar against serving as a director and officer of a publicly traded company. Approximately half of enforcement actions brought by the SEC are accompanied by a Department of Justice criminal indictment. The criminal penalties include a fine of $1 million up to $5 million and a 20-year term in prison. Now, during the first year of the Biden administration, the SEC, under the leadership of Chairman Gary Gensler, had a public focus on the chairman's handful of concerns with special purpose acquisition companies, or SPACs, cryptocurrency, meme and mobile app-based stock trading, and the regulation of billion-dollar private unicorns. This, of course, does not mean that Chairman Gensler or the Enforcement Division are not also focused on other enforcement initiatives, including insider trading. Indeed, the SEC ended 2021 with a set of proposed amendments to Rule 10b-5-1 to combat insider trading, which we will discuss later on this video. So let me contextualize the insider trading enforcement activity. In 2021, the SEC filed 28 insider trading actions. That's comprised both of civil lawsuits and administrative proceedings against 47 persons. This constituted approximately 6% of the total number of SEC enforcement actions brought during the year. This marks a low point for the SEC over the last 5 years. In 2017, the first year of the Trump administration, the SEC filed 41 such actions. In 2018, the SEC filed 51. In 2019, 30. And in 2020, the last year of the Trump administration, the SEC filed 33. Now, I think the lower number in 2021 of insider trading actions was due in large part to the COVID-19 pandemic and how that bogged down or slowed down the enforcement division in investigating these claims. I believe there was a backlog exiting 2021, and we should expect an uptick in filings in 2022 by the SEC. Now, the SEC's enforcement activity and proposed rulemaking in 2021 shows that even with a lower number of trading cases filed, declining from its high water mark a few years ago, it continues to be a key enforcement objective for the SEC. Indeed, some of the actions brought in 2021 showed some creativity and pushing the boundaries on what they believe to be a claim for insider trading. I want to give you just one example. In the fall of last year, the SEC charged a corporate biz dev executive who learned about an impending acquisition of his employer and then traded in the securities of an unrelated company in the same industry that he anticipated would increase in price when his employer's acquisition was publicly disclosed. The SEC's complaint alleges that the defendant, a biz dev executive at an oncology biopharma, learned from the CEO that the company expected to be acquired by a major pharma company within a few days at a premium over the then trading market price. The biz dev executive did not trade in his own company's securities. Rather, within minutes of hearing the news from his CEO, he purchased out-of-the-money call options in another oncology-focused biopharma that he believed would increase in value when the news of his company's acquisition was made public. His company's insider trading policy prohibited him from profiting from the company's material non-public information by trading in securities of another company. The other biopharma stock did increase when his company's news hit the market by 8%, after disclosure, and he profited $100,000. So that shows that you could even be in the crosshairs of the SEC when you didn't trade in your own company's securities.
So, and none of that that you mentioned sort of suffers the reputational harm that one is going to have when they get investigated for insider trading, which obviously is quite a black mark. So Jose, we looked at this insider trading from the outside looking in. Now let's look at from the inside looking out, and how companies are sort of handling this internally. I can remember, and this was many, many years ago, when I was serving on a board, that there was a, quote, safe window which one could trade at. But I always wondered, even in that window, I felt like there were times when you had some preferential information. But talk a little bit about what takes place and how GCs and corporate secretaries fit into the process of overseeing that risk of insider trading internally.
Sure. And thanks, CK. So even though insider trading policies are not required by any SEC rules or stock exchange rules, they are by far the most important way that a company can protect itself, its shareholders, its employees and its insiders from running afoul of the insider trading rules. And I want to focus on two features of an insider trading policy in particular. That's blackout periods and pre-clearance procedures. So a blackout period, when you're in a blackout period, that means certain people, and we'll get to who those people are, cannot trade any securities of the company during that time. Now, if you're not in a blackout period, you're in an open trading window. And companies need to be careful because some employees can, unfortunately and mistakenly think, hey, I'm in an open trading window, so hey, I might have material non-public information, but I can trade, right? Because it's an open window. And obviously that's not true. And that's why whenever a company sends their quarterly reminders of the trading windows or their educational materials, they have to make that clear. Just because there's an open trading window, you still have to make sure you don't have any material non-public information. So there's two types of blackout periods. One is the quarterly blackout period, which I will begin with, and the event-specific blackout period. The quarterly blackout period centers around gathering earnings information for a quarter and disseminating it, right? So when do they open and close? I'll start with when the quarterly blackout period closes. It's a little easier. And that's when a company believes that the financial information they just released, through a press release and an earnings call, typically, when they feel it's broadly disseminated. For the longest time, kind of the standard, period for that was 2 business days. After 2 business days, people felt, yeah, it should be out there. But lately, I've been seeing some companies change that to just 1 business day on the theory that, in our current age, with technology, that information is being disseminated faster. So you're seeing 1 or 2 days. In terms of when the blackout period opens, it's a little tougher, but basically it's when the company has a good sense. They may not have the final numbers for the quarter, but they have enough reliable information that they kind of have a good sense of where the quarter's going to come out. And they know whether they're going to miss their guidance or consensus, whether they're going to hit it, go over. They have a good sense. Usually you want to close that window a few days before that period. So some companies, start off with, hey, we're gonna close the last month, so 30 days before the quarter ends. Other companies, they're more mature, it may just be a week or so. So it really depends on when you feel you have that information, it's pretty solid. Now, one thing we should keep in mind is that businesses evolve, the financial reporting process evolves, and boards should look at their when they close that window and see if it still makes sense, if it's still realistic. Now, who should be subject to these blackout periods? It's almost always your directors and your Section 16 officers. And then you go down to a third group, and that's people who have access to sensitive financial information, right? That's usually your accounting department, your finance department, sometimes the legal department. Those are the people who typically have blackout periods. On the other hand, you have some companies that have just gone public. They have relatively fewer employees. A lot of especially in the Valley, a lot of these companies like to share information with employees, maybe too much information sometimes, and sometimes they're all subject to a blackout period. And as they mature and they get bigger, they might change that, but that's often the case. So with event-specific blackout periods, it's a different blackout period. Those are centered around specific events that might trigger a blackout period. We're talking about large acquisitions or dispositions, internal investigations, SEC investigations, investigating a cyber event, rollouts, a lot of those things that are going to move stock. Now, when to impose those, when you start one, when you end it, those are really tough questions. It depends when is the material ripe? Is the information ripe right now? How big of a magnitude, is the materiality? Those are really tough questions. Sometimes you usually want to get outside counsel involved, especially if they're involved in whatever the material event is. The next feature I wanted to talk about was the pre-clearance procedures. Now, this is a process where certain people, and again, we'll get to who they are, if they want to, I'm sorry, I forgot one thing. Who does the event blackout period, I want to go back to it. Who does that usually apply to? Well, clearly everyone who's in the know. So anyone who's aware of the event should be in that list. But you also typically have the board and the executive officers also, even if there's an executive officer that may not be aware of that event, that information could be attributed to them, or even worse, if they happen to trade, they file a Form 4, then 2 weeks later you announce, hey, we're being investigated by the SEC. It doesn't look good, and they might be, the SEC might have an enforcement action. As you said, they're not pleasant. Now, going back to the pre-clearance procedures, those are procedures where certain people have to get pre-approval for their trades during an open window. And there's 3 reasons why you typically set these procedures in place. One, obviously, you don't want someone to inadvertently trade on material non-public information. Secondly, it's good proof that not only have you adopted this insider trading policy, but you're actually enforcing it. And third, it helps a company with Section 16 compliance. So if an executive trades, Form 4 is going to have to be filed. Again, making sure there's no short swing profit issues. And these pre-clearance procedures can come in different flavors. Some companies want 24 to 48 hours advance notice of a trade you're going to make for them to clear you. And some companies put a specific period for the pre-clearance. So they'll say, we'll pre-clear you, but you have 3 or 5 days to trade. If you don't have something like that, then the company should make sure they're keeping track of who they're pre-clearing, because there's a subsequent development where some material non-public information happens, you're going to have to follow up with those people if they haven't traded. And pre-clearance procedures similar to blackout periods. It almost always involves directors and officers, and then high-level executives who have access to, again, sensitive information, like your high-level personnel in their finance and accounting team. If it's an acquisitive company, the M&A team might be in that pre-clearance procedures, general counsel, legal department. So those are people that are typically involved in those procedures. And that's kind of the two that I wanted to focus on. Now, there are carve-outs sometimes for these blackout periods. And for me, one of the best ones is the 10b5-1 trading plan. And I think, Greg, you were going to talk a little bit about that.
Well, let me just add something before we get into that. And we're running longer here, but to give a practical explanation of that, when I served on a public company bank board, typically they would announce their quarterly earnings on about the 20th of the month. And then following that month, I would get internal financials on what happened in that month after the quarter. So I had a window of about the 20th of the month after the quarter to the 10th of the month of the following quarter, at which point I received information on that undisclosed month of financials, which gave me what I felt at the time, Jose, was internal information that was not released to the public on how the company was doing. So that's how we sort of established our window. And then with the pre-clearance, it made it pretty solid on that front when you could actually trade something. So you mentioned 10b1. Let me just turn it over. There was an announcement just made. This has been in process, and a lot of executives took advantage of 10b5-1, Greg, but they were almost gaming the system, I'll say, okay, and finding ways to start one, stop one, doing things. So they came out with a new set of rules that was, for the most part, pretty unanimously backed by the SEC, although the implementation was nothing. Talk a little bit about the proposed new rules. I know we're in the comment period. Talk about what directors should be prepared for. And I want to try and make sure that we make this succinct so that we can stay on time.
Yeah, definitely. So you are correct, TK. Over half of the S&P 500 companies have executives or officers or directors who use 10b5-1 trading plans. It's widely used in corporate America. Rule 10b5-1 was enacted in August of 2021 years. It provides corporate insiders with an affirmative defense to insider trading liability in certain circumstances, where the trade was pursuant to a binding contract, an instruction to another person to execute the trade benefit, or a written plan adopted when the trader was not aware of material non-public information. Now, these amendments proposed amendments came out in December, and we're still in the comment period. Many of them were, I think, largely needed. There was some gamesmanship being played by timing the disclosure of company news to benefit a 10b5-1 trading plan. There was certainly gamesmanship with respect to employing not one, not two, but many 10b5-1 trading plans that overlapped. And then you could cancel one plan but not another to benefit yourself based upon information. So many of these reforms are needed, but there is some confusion in the rules that I think we'll handle through the comment period. But Jose, go ahead and tell us about the amendments.
Yeah, yeah. And very quickly, some of these amendments, as Greg noted, seem okay. And many law firms, and our firm included, gave guidelines to companies who were allowing 10b5-1 plans. And to a certain extent, some of these SEC amendments, we typically said 90 days should be enough between a signing and your first trade. The SEC says, well, we think 120. That's fine. I think one of the proposed amendments that's causing a little concern is where you needed to adopt a plan in good faith. Now you need to operate it in good faith. And the concern there is if an insider needs to amend their plan for changing conditions, or maybe they have a plan and the company's going to miss their quarter and they don't want to have a trade right before that because it looks bad. Now, when you amend, if you amend or terminate that plan, they could say, hey, you're using material inside information to do that, even though might be you have a good heart when you do that. So it's creating, I think, some uncertainty, and we're going to want to make sure we understand how they will enforce that provision. I think that's the one provision we're a little bit concerned with.
So, guys, we have run out of time, but I wanted to thank you both. This is a very important issue because nobody wants to fall prey to being in the news relative to insider trading. It doesn't help anything in the corporation, that's for sure. And I appreciate you both taking your time to sort of bring us up to date on what every director should know.
Thank you.
Thank you.
And that will conclude this edition of Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.